Thanks, Dave. Thanks, everyone, for tuning in this afternoon. Lots of good presentations going on today, and hope to continue that trend here. We're going to be talking about day trading, the E-mini futures. At least that's where a lot of the examples and screenshots and charts are going to come from. But the concepts and the overall strategy and ideas that I apply to my day trading you can use across all different markets and time frames. So if you only trade stocks, or even if you trade options, there's lots of ways you can easily transpose the concepts into whatever market you're trading: stocks, forex, futures, options, across the board. So as Dave said, my name is Tim Racette, and I blog over at EminiMind.com. And as the name implies, my main focus is the E-mini futures. And a big part of my trading forte, if you will, is the emphasis on the mindset side of trading, whether it's day trading, swing trading, across the board. There's a lot of great strategies out there and a lot of different approaches that in themselves do work, but there's a lot of places or different ways that traders can get hung up that I've gotten hung up on over the years, and different things to overcome and challenges and things like that. And the mindset portion of my trading has focusing on that side has really helped advance my trading over the years. So we're gonna run through a handful of things as far as kind of details of how I trade, my overall trading philosophy, trading strategy, and things like that. So we're going to go through kind of 3 trading techniques, and I'm going to be specifically addressing the 1-minute chart, candles, and trade setups that are likely to get the most momentum. So, whether you're trading the SPY ETF or the E-mini S&P or the NASDAQ, micro NASDAQ, the concepts, like I said, will be applicable to all different markets and timeframes. We're going to talk about what I call kind of the high of low bar, low of high bar entry, as well as some highly effective trail stop techniques. So even if you don't use the same entry or strategy that I use, you can apply the trail stop techniques to the market that you're trading. And especially when it comes to intraday trading, being able to repeat the process day in and day out has a lot more value than just kind of haphazardly catching a big winning trade and then not really knowing how can I replicate it or how can I duplicate that process. So I've always put a lot of emphasis and value the ability to replicate different pieces of my trading. And so I'll show you a few techniques that you can use to help you learn that and do that. So the whole goal of all of this is to build a flexible, kind of financially free lifestyle. I think that's why most of us turn to trading. Some are kind of in the retired camp and either just interested in the markets and looking for something to do, interested in the markets and wanting to have kind of a supplemental income or generate some income from a small pile of cash that they have. In addition to, if you're retired, you might have a 401k or a pension or something like that. Or if you're, working or younger, maybe it's just to kind of get out of the rat race and be able to have some flexibility in your life. And, a lot of times trading can be seen as an easy path to getting rich or making a lot of money, but there's definitely a lot of challenges on the mental side that can trip you up or slow you down. So we'll talk about some of those things as well. And whether you are trying to free up your time to just not have to go work or into an office every day, or you want to be golfing, hiking, biking, grandkids, kids, community activities and things like that, whatever your individual drive is, it's helpful to kind of stop and ask yourself, what am I trying to get out of trading? Because trading is just a means to an end. So whether you want to be, a full-time trader or a part-time trader, I would argue that the best way to bring on trading and fit it into your life is sort of as a kind of part-time endeavor, in a way that, yes, you put a lot of emphasis and energy into your trading, but you're not sitting there 9 to 5 or 9:30 to 4:15 Eastern time looking at the markets every single day. You focus in on, one market, one time frame, one strategy, and one chunk of the day. And that way, it kind of helps put up some guardrails or bumpers from limiting the time that you're exposed to the markets, because especially when you're trading the futures markets, you've got 24/7 opportunities to trade. You could be trading stocks, and then when the Nicey closes, you jump to the forex markets and futures markets, and you could be going 24/7, and it can be a slippery slope on days where things might not be going so well. And so if you can put some hard limits on when you're going to trade, what you're going to trade, that can really help kind of give you a sense of control and help feel like you are on top of what you're doing, as opposed to just being completely at the mercy of the markets and feeling like you're barely able to tread water. So a little bit about myself before we jump into all the nuts and bolts. My name's Tim Racette, as I said, and I've been trading for about 15 years. I got my start in the Chicagoland area and had a lot of opportunities to mingle with traders, get involved in, just exposed to the trading world. You got the Chicago Board of Trade, Mercantile Exchange. Thinkorswim was kind of coming into their own in the early mid 2000s. Tom Sosnoff, Don Kaufman, all those guys. And so had a lot of access to traders and big ideas like that. And so especially on the computerized trading side, when I'd gone down to the trading floor, the guys that I was introduced to, a buddy of mine and I, we're young kids at that point, college, high school, college age, and they are kind of shooing us away from the pits because they can see that, the pits are dying. And a lot of the guys in the trading pits have computer terminals outside of the pit, and they would do some, technical analysis and then go into the pit, or they're just getting phone calls from, bigger, from the institution saying, okay, we need to sell this many ES futures contracts, go put on, go dump these 500 orders or put this short position on. We're going to be hedging. We're a hedge fund and we've got a long stock position and we need to, have a short 500 or 1,000 ES contracts to hedge this position. So there wasn't a lot of opportunity as much for the arbitrage side of things. So that's kind of how I got involved with the day trading, or with the computerized trading side of things. I really got my start swing trading for a couple years and then turned to day trading shortly after that. So primarily now I'm day trading the E-mini S&P futures, but I do still swing trade stocks, and it is a nice pairing to have, some swing trading positions when the volatility is low, the market's just kind of cruising in a tight uptrend. And when you have those conditions, well, there's not always as many day trading opportunities. There's not as much movement intraday, and so the moves can be slower, fewer opportunities. But then vice versa, especially when you get into like bearish market conditions or even sideways, higher volatility market conditions, a lot more day trading opportunities, but it's harder to stay into and even find swing trades that might, keep you in a move for a couple of weeks or a month or two at a time. So it's okay to pair kind of similar, but strategies that don't conflict necessarily like at the same time of day. So not to delve too much on the swing trading side of things, but if you do swing trade, you're probably looking at daily bars. And so you can do all of your analysis after the markets are closed, maybe, figure out what order or what price you want to get in. And then once you're in a trade, I'm just managing those trades at the close. I'm not really looking at the trades intraday. I'm not doing much with them at the open. So the Nicey Open is where I can focus on the day trading side of things. So they're kind of two separate approaches, and so they don't conflict with each other, and I don't have to kind of be doing both at the same time. So I've had the pleasure of speaking at a number of the Festival of Traders, as well as your Traders Expos and things like that. Always fun to kind of get together in person and meet folks. I know a lot of you out there are probably trading by yourself in the home office kind of situation, and don't have a lot of traders to connect with. And I was lucky, like I said, being in the Chicagoland area, to have lots of access to trader meetups and things, and meet lots of traders in person, and had a couple of close friends who we traded together. And that really helped kind of the early years move things along. You can learn together, you can bounce ideas off of each other, and keep you going. Especially you can have some challenging times, or days or weeks where you might have had a bad trading day, but then your trading partner or friend had a pretty good day, and you can kind of dissect what went wrong. And the funny thing is, you're both looking at the same market, but it's how you kind of process, or the lens that you look at the market at, to spot those opportunities. So outside of trading, though, I like to spend a lot of time outdoors, mountain biking, hiking, and doing all that kind of stuff. I actually live in Scottsdale, Arizona now, and lived there for the last 10, 12 years, and it's definitely a warmer place to be in the winter than Chicago. So I had originally gone to Arizona State out in Tempe, and then I don't know, 5 or 6 years later, moved out to Scottsdale as my home base. So that's kind of a little bit about me. Let's dive into kind of my chart setup, how I set up my trades and manage my trades, and kind of the nuts and bolts of how I look at the markets each day. So this is my basic chart setup. I use Thinkorswim, but you can use any platform. A lot of people are using NinjaTrader. There's a lot of good platforms out there. I've just kind of got started on Thinkorswim in my early days and stuck with it. My eyes are very accustomed to the charts, and you'll find that the more you clean up your trading screen, like I have 2 monitors. My one monitor is this screen that you see, the charts, and then my right monitor is, I'm kind of old school. I use an Excel trading journal, trade log, and that's also where I have my trade ladder, and kind of put the orders in on the right side of the chart with my Excel trade log, and then just my charts on the left that I can kind of toggle through between different time frames if I need to. But I'm not a big fan of having 50 different charts on the screen and 4 or 5 different monitors, just because it can become a little overwhelming, and at some level cause some hesitation with placing orders. So I mentioned how there's a lot of good trading strategies out there, but if you start to compile and overlap too many strategies on top of each other, then you get this like paralysis, where you're waiting for this setup to occur and then this thing to occur, and you need all these different things to kind of overlap before taking a trade. So keeping your trading screen as clean as possible is a really good exercise. If you look at the chart or look at your trading screen, all the stuff you have on there, go through each box or section and ask yourself, am I using this chart, tool, indicator, whatever it is, to enter, manage, or exit the trade? And if it's not helping you do one of those 3 things, then you can get rid of it. So the candlestick basic structure of the chart patterns and candlesticks are kind of the foundation of most technical analysis. And just like a football team would, an NFL team would start every year going back to the basics of blocking and tackling, it's always good to have a good understanding of the basics of candlesticks, chart patterns, basic swing highs and swing lows, identifying uptrend, downtrend, sideways trend. The more you can master those fundamental basics, the easier it will be to make quick decisions, when the market's throwing stuff at you really quickly. So things like hammer patterns in an uptrend and looking for things like double bottoms, those are all helpful indications that the market is going to kind of resume that uptrend. So a lot of times you can be looking at a chart and it's going up, down, and sideways, especially if we're talking about, let's say, a 1-minute chart. There can be a lot of noise. And so if you pull back or zoom out to, say, a 5-minute or a 15-minute chart, if you're day trading, those can be helpful ways to kind of get a picture of what is the larger trend on the morning, especially a 5-minute chart. If you're going to be looking at the markets at the Nicey Open, that'll start to give you, 3, 4, 5 candles. Now you're 20, 30 minutes into the day, and you can start to see, are these bullish candles? Are we making higher highs and higher lows, forming an uptrend? Are we just moving sideways? Are they inside bars, etc.? And so, yeah, looking for basic candle patterns to help understand kind of those emotions of fear and greed. And if you have a big body candle, they don't have to be green and red like mine are. That sometimes they're filled and unfilled. Those different candles, big body filled candle would be a bearish candle, and the most important candles that help with spotting reversals and trend changes and kind of resumption of that larger trend are the hammers and inverted hammers. Sometimes they can be kind of in the form of a doji, where the open and close are at the same price. And in general, the idea of price starting at one level and then selling off and then rallying back up to around where it started, whether it closes at the exact same spot or a little bit higher, a little bit lower, that idea is what's forming the hammer, or in the case of a short and inverted hammer. So if we were to turn the chart upside down, you end up with a candle where price will shoot up or start rallying and then be pushed back down by bears, sold off. There's a lot of different reasons that price can go up and price can go down. It's not just sellers selling. It could be buyers who were long having to cover their position. And so the candle is going to help indicate whether or not the price move is strong or weak. If you have a bunch of small candles that are just kind of moving sideways, overlapping each other, there's not a whole lot of thrust, if you will, or momentum. But when you get hammers and inverted hammers, and especially if you kind of look for things like double tops and double bottoms, those are really helpful indications that either a new trend is starting or we're starting to gain some support and resistance. So in an uptrend, we're looking for double bottoms. In the downtrend, we'd be looking for double tops for short positions. Hammers, we'd be looking at long positions. And they're really powerful because they signal that price rejection. And when you have a strong price rejection, price could come up, hit the prior day's close, prior day's high, make a double top, that kind of thing. And we can then look to get short, in the case of an inverted hammer, as the momentum is kind of snowballing. So the HLB, LHB just stands for high of low bar and low of high bar. So all that means is that I'm looking for the high price of the candle, and the candle that I'm looking to get in on or place the trade on is the lowest bar in the pullback. So high price of the lowest bar. So if you're in an uptrend, you're making higher highs and higher lows. I'm looking for hammers that have, the market is in an uptrend. We've pulled back, could be a couple of candles, couple of bars, and then looking to get long above the high price of that hammer, which then by definition will be the lowest bar in the pullback. And with futures market, one tick is plenty to set your order. If you're trading stocks or ETFs, you might use a 5 or 10 cents, something like that, depending on how big how high the stock price is. But with the futures markets, you can be very tight and precise with your orders. There's also some tax benefits with trading futures. So you don't have the pattern day trading rule, which is kind of a blessing and a curse. A lot of people turn to the futures markets because of that lack of restriction, but you can also get burned and lose a lot very quickly if you're not paying attention and setting stops and coming in with the plan. So now with the micros existing in the last few years, you can be trading real money with very, very little risk. And so when I started trading, getting to 2 E-mini S&P contracts was a huge achievement. And the only way you could do that is go from 0 to 1 to 2. Now you can trade the micros, and you could trade 4 micros, work your way up to 1 ES contract, and then go up from there. And in a lot of ways, trading multiple contracts is actually easier. It's kind of a tangent here, but the idea of being able to exit in multiple places and scale out of positions can be very helpful. We'll talk about that in just a few minutes. So high low bar for long entries, looking for a hammer, getting long 1 tick above the high. And I purposely left the x-axis off here. This chart could be a 1 minute, which it is. It could be a 5 minute. It could be a daily chart. It could be a weekly chart. And so, like I said, these concepts, the idea of the high to low bar, low to high bar, can be used, on many different markets and timeframes. So low of the high bar, if we turn the chart upside down, is just the same thing, only with a short. Looking for price to break the low price of the candle, and that candle is going to be the highest bar in the bounce or in the pullback. And circling back to those higher time frames, looking for areas of resistance, prior daily highs, a prior gap fill, a prior high from earlier that morning to make a double top that corresponds with the inverted hammer is a great setup. Some extra confluence to help. You could also, you could be using a 50% retracement. There's all different ways, pivot points. So you don't have to have 50 different things line up before you place a trade, but a little bit of support and resistance that lines up helps give that extra confidence and confluence for placing good trades without hesitation. So looking for those inverted hammers, low of the high bar, and then with longs, high to low bar. So the initial stop you can use for this type of trading. If you're going to be on a small time frame like a 1 minute, you can use the candle as your entry size if the candle's reasonable. A lot, these days, 1 minute candle on the ES is going to be 2.5, 3, 4 points. If volatility is a little bit higher, we might have a 5 or 6 point candle. But when volatility, when the VIX is up in the 30s, the candles might be 7, 8, 9 points. So it's important to balance your reward with your risk. So if you're only getting 2 and 3 point candles for the day, you don't need to have a 10-point target necessarily. But if you have a 8-point candle and you're setting your stop at 8 points, you don't want to just be taking 1 or 2 points. If the market is moving larger, moving faster, moving with a bigger range, then you want to be having a target that's, ideally at least 2 to 1 your risk. So one alteration, I guess, to using the whole candle as your stop. So if it's a 3-point candle, let's say you put your order 1 tick above, the stop is 1 tick below. Therefore, you get a 3.5-point stop. I've found that the best trades go very quickly. They don't spend a lot of time, chopping around, trading inside that signal bar. So you get a hammer, the best trades kind of break the hammer's high, and then boom, they start going. So 3 points is typically a really, really good place to set your stop. Now there are going to be times where it comes down and it might tick you out and then end up going in the direction that you want it to go. But by and large, over years and years of my trades, looking at what was I always keep track of the max profit on the trade, how much heat I took on the trade, which is how I kind of determined 3 points was a good number. How much is the trade going against me before it goes in my favor? So 3 points is a good place to set your stop, and then that allows you to use a 6-point target as a one opportunity to exit the trade. So when you get a hammer looking for longs, inverted hammer looking for shorts, if I go back to this first chart, you can get long if the market is going down. That would be considered like a counter trend trade. Market's coming down, or let's say the market's moving sideways and you're picking up a hammer down at lows. That would be a counter trend trade, versus if you're just going long in an uptrend on a small pullback, that would just be kind of going with the trend. So typically going with the trend is going to be a little bit less risky, but your bigger moves can come from the counter trend trades. So the other option for a stop placement, and this is why being able to trade multiple contracts is helpful, using a trailing stop. And so trailing swing highs and swing lows is a really good place to look for placing your stop. And so if you start with your initial stop at 3 points or below the candle, for a long example, waiting for the market to make a high and then pull back and then break that high, then you can move your stop underneath the next swing low. Then it makes another new high, pulls back, makes a new high, and you can bring it up to the next swing low. So you might be waiting, 3, 4, 5 bars for the market to kind of break out, pull back a couple bars, and then break out again, and then you can move your stop up. And again, this works really, really well for swing trading, for daily bars, for lots of different types of entry points, because you're staying in the trend as long as it's going with those higher highs and higher lows. To flip it upside down, if you were short, you'd just be waiting for the market to break lows, bounce a little bit, break lows again, and then you can just continue to move your stop just above the most recent swing high. A little bit more aggressive trailing a stop approach is to trail each candle. And for day traders, this can be a little more advantageous just because you're quickly reducing your risk. So if we were to, let's say this red hammer is the entry bar, or the signal, and then you have an inside bar following that. I will just as a sidebar, I will typically leave my long entry on the bigger bar of the two versus dropping it on an inside bar. I don't have a ton of specific trades that I take where I get like 2 hammers in a row like this, but just for simplicity's sake, I typically leave my order above the high of the larger bar. And so if the entry bar is number 1, the bar that breaks the hammer's high, then I can move my stop underneath that candle if I'm trailing each bar as soon as the next candle starts to form. And then once candle 3 starts to form and 2 has closed, I can move my stop underneath that candle and continue on until I get taken out. So that's a really good strategy. Again, daily charts is great as well, but intraday it's a really helpful one. So after four candles in a row, you can start by trailing swings. So if you're long, you're trailing swing lows as it goes up, up, up. And then if you get 4 consecutive candles in a row that all make a new high, then you could switch to trailing each bar, just so that your stop isn't, like 10 points away. You don't want to be giving up a huge unrealized gain on an intraday basis. So that's one little technique to kind of use both approaches together. So a couple examples of like a high or low bar, market comes down, forms a hammer, breaks above the high price of the hammer, and then if you're going to trail each candle, you would just continue to do that until you get a bar that breaks the previous candle's low. And so you can do a combination also of a 6-point target and a trail stop. So as long as you have 2 contracts, you can kind of do a combination of the 2, and that's really helpful to just be able to not have to be very specific with how you're going to exit the trade. You can kind of catch the runner and catch the small target as well. So double top, same kind of thing. Could be a any resistance area, but as long as you get that double top, that kind of helps give some extra resistance towards the short to follow. You could use a halfway back as a kind of area to look for the hammer and get some extra support, and then getting long above the high to low bar. The Nicey Tick, I'm not going to go into a lot of detail on this, but Nicey Tick is really helpful. You want to be getting long and low ticks and short and high ticks. So if you're day trading, I highly recommend checking out the Nicey Tick, I guess, indicator, if you will. And so, the main idea is that we're looking for those hammers to get long and inverted hammers to get short, looking for things like halfway backs, double bottoms, double tops, areas where you might find support and resistance. The 21 exponential moving average is a good place. And then from a long side, looking for a low Nicey Tick at the same time that you're getting a long setup. And then on the flip side, inverted hammer would be at a halfway back short, at a double top, again, the 21 exponential moving average, and then a high Nicey Tick for going short. And then the stop placement, you can use the candle itself. So put your stop outside of that signal bar. You can use 3 points, which, especially when volatility is low like this, that's a really good spot to start your stop. And then when it comes to trailing the stop, if you're using that 3-point stop, you can use a 6-point target, and then you could trail each bar. You could trail swings, and you could start by trailing swings, and then if you get those 4 breakout bars in a row, then you could tighten your stop and start trailing each candle from there. Because again, you don't want to leave a whole bunch of profit on the table. And so while I'm not a huge fan of quantity of trades, like let's say I make 3, 4, 5 trades in the first 90 minutes of the day, that's a great trading session. It doesn't have to be 10 or 15 trades all making a point each. I'd rather have quality entries and catch 8, 10, 12 points in a trade, because that's one opportunity to be stopped out. So like every time you put on a new trade, you're starting with a full stop out, and that full risk is then on the table. So always good to think about kind of the reward to risk when you go into the trade, and not just be thinking about, ooh, this setup looks really good, let me go 10 contracts and I'm going to just try and take a point and just scalp and take a quick win, because that always ends up spiraling out of control, and you might do okay once or twice, and then all of a sudden you have one loser and it wipes out, 3 or 4 winning trades. So that's what I've got for you today. I know we kind of went over a lot of stuff really quickly, but that's kind of the basics, ins and outs of the what I call the hammer and inverted hammer trading strategy. If you have specific questions, you can always shoot me an email. It's on the screen there, and feel free to watch the recording a couple of times over in practice, and then work your way up to trading the whatever market you like to trade. So thanks for tuning in, everyone. Thanks for having me, Dave, and we'll talk to you all soon.